Hello everyone and welcome to Investment Research. I'm Simo, your equity research analyst. If you're seeing this video for the first time, make sure to subscribe so you don't miss my daily stock reports. Today, I'm taking you through a careful analyst look at AMC Entertainment Holdings, ticker AMC, as of October 29th, 2025. I will be transparent about my approach so you know how I reach conclusions. I follow the same components a professional equity research note follows: a concise top-line view, a look at the business and competitive context, a clear read on the most important financial and operating metrics, an investment thesis explaining why I would or would not own the stock, the concrete risks that could break the thesis, and finally, a valuation frame and practical recommendation you can act on. I will speak plainly and in real investor language so you can decide whether this fits your portfolio and your risk tolerance. First, let's look at the market snapshot and price action. As of today, AMC shares are trading around $2.70. Note, precise quotes may vary, which is well below the recent 52-week high of about $5.56 and modestly above the 52-week low near $2.45. The share price is reflecting the fact that while the theatrical exhibition business is recovering, the company still carries heavy leverage and faces structural headwinds. The volume and options activity around the name remain elevated. This is not a dull name, it moves on sentiment as much as fundamentals, and the retail/trader component remains significant. Now let's put the business in plain English. AMC is the largest theatrical exhibition company globally with thousands of screens across the United States and internationally. Its core revenue drivers are admissions, ticket sales, concessions, food and beverage, and increasingly premium/special event content like limited theatrical runs, music film tie-ins, and alternative content, gaming, experiential events. AMC has sought to diversify beyond pure first-run Hollywood films into premium large format screens, subscription/lifestyle offerings, and event-driven cinema experiences. The strategic pivot in recent years has involved strengthening the balance sheet through refinancing, reducing debt burden, extending maturities, and improving liquidity, while leveraging a recovering box office as theaters reopen fully after pandemic disruptions. Let us review the most important recent results and operating context because numbers and metrics separate the story from the aspirational. For Q2 2025, the latest publicly reported quarter, AMC reported revenue of approximately $1.40 billion, up approximately 35.6% year over year, driven by higher global attendance, around 63 million moviegoers, and improved per-patron metrics. Adjusted EBITDA rose dramatically by approximately 391% to about $189 million, reflecting operating leverage and stronger guest yields. However, the company still carries substantial debt and conversion into free cash flow remains a risk. While Q3 2025 numbers are not yet released, the earnings date is set for November 5th, 2025. The market has already priced in both hope and caution. The backdrop shows box office expectations improving modestly. Industry forecasts project around a 5% year-over-year increase in North American box office in 2025. The company also recently announced a major event release, Taylor Swift, the official release party of A Showgirl, distributed by AMC's distribution arm, which generated over $50 million globally in a one-weekend run, showing the power of premium alternative content. At the same time, a recent report flagged a risk of massive dilution with management proposing to double authorized shares to 1.1 billion, a significant potential overhang for shareholders. Now let me walk you through my investment thesis in plain words. I see AMC as a speculative recovery play with meaningful upside but also meaningful risk. The upside. If the theatrical business continues to rebound, event-based content and alternative revenue streams scale, per patron yields continue to improve, and debt continues to be managed down, then AMC could benefit disproportionately from the recovery narrative. For traders and higher risk growth/turnaround investors, this may be attractive. However, I would not treat AMC as a core defensive holding. It remains a high volatility, high execution risk name. My bias, moderately bullish for the speculative sleeve of a portfolio, but only for investors who are comfortable with the chance of downside and queuing up a catalyst, such as the November 5th earnings or a major event announcement. Let's be clear about the risks that could break the thesis. First, leverage risk. The company still has heavy debt, and if attendance or guest spending weakens the cash flow implications, could force equity dilution or covenant stress. Second, content/box office risk. The business depends on a steady stream of compelling films, event releases, and strong consumer discretionary spending. If major studios miss or theatrical windows shrink further, streaming first, then it puts pressure on AMC. Third, dilution/authorization risk. The proposal to double shares is a major red flag. If enacted, current shareholders face meaningful earnings/share dilution. Fourth, macro risk. Consumer spending may be hit by inflation or recession, which would reduce movie attendance, concessions, and premium pricing. Fifth, sentiment/trader risk. AMC is still partly a meme/trade name, meaning price may move on sentiment more than fundamentals, which can create sharp reversals. Now, a frank view on valuation and expectations. The market is pricing AMC like a turnaround story rather than a stable cash flow asset. For the business to command a higher multiple, it needs to show consistent cash flow improvement, debt reduction, and growth outside of the classic Hollywood cycle. In my view, if AMC executes well, the next 12 months could see a meaningful re-rating, perhaps an upside scenario into the $4 to $6 range if everything breaks positive, attendance rebound, alternative content success, dilution avoided. Conversely, if execution falters or dilution is announced, the downside scenario into the $1 to $2 range is quite plausible given the current sub $3 price and elevated risk. Therefore, my recommendation is to treat AMC as a buy for the speculative sleeve of the portfolio, size modestly, and treat it as a catalyst-driven trade rather than a long-term core hold. If you hold, be ready to trim into strength or exit if dilution or weak guidance emerges. What will I be watching over the next 90 days? The upcoming Q3 earnings, November 5th, is the immediate catalyst. Key metrics: global attendance trends, per patron spend, premium format revenue, liquidity updates, debt maturity schedule, and any commentary on share authorization or dilution. Also, watch major event releases and alternative content launches, like the Taylor Swift event. These can act as near-term triggers. On the trading side, monitor options activity, volume spikes, and sentiment shifts as the meme/trader element remains strong. For tactical notes, if you trade this stock, use limit orders rather than chasing large runs. Consider hedging or using options given volatility. For investors, keep the position small relative to your total portfolio risk. If you want, you can pair AMC with more stable media/entertainment names for diversification. That is my current view on AMC Entertainment as of October 29th, 2025. I'm Simo from Investment Research. If you found this useful, please like and subscribe and leave your questions below about which metrics you'd like me to model in a scenario-based valuation, attendance, event revenue, debt reduction, and I'll build it for the next update.